in talking and understanding how indirect rates work, we're going to talk about different types of government funding vehicles, specifically flexibly priced government vehicles, commonly known as cost-plus awards. So cost-plus fixed fee is the most typical award that you'll see. We're going to discuss what your government funding strategy is and how you should think about this. I want to make sure that you understand a concept known as the multiplier. We're going to talk a little bit about how the government views indirect rates and what they see as normal. We're going to talk about what indirect rates are used for, and then we're going to explore whether you have a project or a business and how you're thinking about indirect rates needs to change as your project evolves into a business. And then we're going to talk a little bit at the end about safe, quote, safe rates and why they may not be so safe. We've received probably 40 questions in advance, and I've ferreted through probably the 7 or 8 that I think are the most appropriate. And if we have time, we will answer as many questions as we can. But I'd like to respect the fact that we're going to go for an hour, and so I'll probably present for 45 or 50 minutes and take Q&A. So if something isn't clear, if you can send me a chat, I will attempt to incorporate it into the presentation. So with that said, and I swear this is the only time I'm going to do this to you today, but the Federal Acquisition Regs, or FAR, is what governs federal government contracts and grants. So typically when you're talking to a CPA, you think your tax accountant, well, he's somebody who's an expert in the Internal Revenue Code. That's not really relevant to government contracting or granting. However, in order to become a CPA, I had to demonstrate that I was proficient in generally accepted accounting principles, which is very relevant to the underlying accounting that goes on a day-to-day basis. But the actual understanding of the federal acquisition regulations and the cost accounting standards is really a specialty niche. So just because you have an accountant doesn't mean they have any idea what you're talking about when you start doing business with the government. So to make matters even worse, each government agency has the right to issue their own supplemental regulations, and they do. So not only is there a federal acquisition reg and a cost accounting standard, but there are also Department of Defense supplemental regs, NIH supplemental regs, Department of Energy supplemental regs, and the differences can be enormous. So as an example, the Department of Defense will reimburse you for your intellectual property costs, your patent costs. National Institutes of Health won't. So the the salary cap for NIH grantees is about $195,000 to $200,000. For DoD, it's closer to $500,000. So there are very stark differences between how the agencies apply those rules. The entire reason that our firm exists is because of this FAR clause 52.216-7. It's known as the Allowable Cost and Payment Clause. And when this clause is embedded in your government contract or grant, it means you have a cost reimbursable award. So the government does business basically 3 ways. One is fixed price. I'll sell you this pen for $1.99. The second way is on a time and materials basis. Hey, I'll give you $50 an hour to dig me a hole. And the third way is we're not really sure what the cure to cancer is, but we will reimburse you for your allowable costs and allow you to keep certain intellectual property in return for your research. So this is typically a clause found in R&D contracts, very specifically found in SBIR, STTR Phase 2 awards, ARPA-E awards, R01 research grants, broad agency announcements, and BARDA awards. NIH also stipulates that you have a cost type award when you have a Phase 1. So all of these awards are effectively cost reimbursable type awards. So in order to understand indirect rates, you have to understand the government is going to reimburse you for your allowable, allocable, proportional costs. So indirect rates, the way I'd like to think about indirect rates is they're sort of the key to building your business. You're not going to get rich as a government contractor. Effectively, you're going to receive a 7% fee, and you're going to develop intellectual property and hopefully build a business. And that's really sort of your goal when you get government funding. It's a way for very risky early stage work to get funded. So this is a frequently asked question we get, and I speak all over the country, and I hear this all the time. So here's the, and this is sort of going to be the central point of the discussion today. So we're in a business incubator and wanted to put as much money as possible into the scientific project, so we didn't ask for fee, overhead, or fringe benefits. We intend to develop a commercial product, and the strategy seemed to work well for getting our project's initial funding. Will this decision affect future grants? So again, this is a question we get all the time, and what I want you to think very, very importantly is, what is your strategy for using government funding? Are you going to use government funding as a one-off type thing, or are you going to try to continually use government funding to develop your business? Secondarily, are you bootstrapped or are you VC backed? This is a really important question to ask yourself, because if you're VC backed, VCs and angels see government funding as sort of money they don't have to come up with, so they don't particularly care if the government is reimbursing you for direct or indirect expenses. But if you're bootstrapped, today's seminar is critically important to whether you succeed or fail as a business. So with that said, indirect rates give you the money to build your business infrastructure. It allows you to hire people, put facilities and processes into place, and allows you to work on the business. And so that word "on" is something that I really want you to think about. We're going to talk a little bit about how a project morphs into a business, and you need to go from working in your business to working on your business. And indirect rates are a critical element that you're going to need to work on your business if you're not VC backed. If you're VC backed, most of the time the strategy is, let's put a ridiculously low indirect rate in. We don't really care that we lose money on the project. This is just a way to subsidize the VC. So if that's the case, you know, maybe you want to put the presentation on mute and kind of go to sleep. But if you're bootstrapped, or if you don't want to lose money, you probably want to pay attention. So before we get going, it's important that you understand one of the most important things that you need to do is maintain an acceptable accounting system. And an acceptable accounting system requires that you know the difference between a direct and indirect and an unallowable cost, and that your general ledger be set up to accumulate costs accordingly. So you have to have a general ledger that is able to break down costs between direct, indirect, or unallowable, and you also need to maintain job cost reports. So that's critically important. It's really what it takes to maintain and set up that accounting system is outside the scope of today's webinar, but we do have, I will bring you over to our website. So if you go to jamiesoncpa.com and you come over here to resources and you go down to webinars, you can see we've done some webinars that are recorded. So we've got audit trends in awards, A133 audit, and then down here we've got some recorded webinars. I would strongly recommend that you take the DCAA compliant accounting system requirements and watch this webinar. It will give you a great understanding of kind of what you need to do to set your system up and get it compliant. So, and it's about an hour webinar. We run these probably twice a year, so you can do, you know, we'll do the webinars live and you can ask questions. But it's really a topic unto itself. So I like to get people kind of thinking about what's the difference between a direct and indirect or an unallowable cost. So I usually start with how do people see expenses that weren't in the original proposals. So I get this question sort of all the time from a practical perspective, which is, hey Ed, we didn't propose this in the contract, how do we deal with it? I've been around for a long time, and I've got to tell you, I have never met anyone who could write a proposal and see so perfectly into the future that they literally proposed every possible contingency and included them in the award. When you write a proposal, it's your best guess as to what you think you're going to do and what you think it's going to cost. What happens in reality is almost never what you proposed. So the government used to get pummeled with contractors and grantees calling them all the time saying, hey, mother, may I rebudget this? Mother, may I rebudget that? In the proposal, I said I was going to spend the money on this, but I'd really like to spend the money on that. That's really no longer necessary. The government, typically when they fund these things, will allow you to rebudget up to 25% of the award. So if you've got $1 million award, you can rebudget $250,000 of that award without permission. Now, if you're materially changing the scope of what you're doing, I would go back to your contracting officer or your grant specialist and get their permission to do that. But you know, deciding we're not going to subcontract this, we're going to perform it in-house, these sorts of decisions happen all the time, and usually terms and conditions exist within your contract or grant award that allow you to do this. One of the things that I want to make sure you're aware of too is if you've got a government contract, you've typically got a 30 or 40 page award, and you'll have 2 or 3 pages of FAR clauses. So you'll notice the allowable cost clause in those list of clauses that apply to you. With NIH grants, you'll get a 3 or 4 page notice of grant award, and there'll be a little hyperlink for the terms and conditions of the award. And when you start clicking into those NIH grants policy statements, you'll find thousands of pages of regulations, which is why I sort of summarized for you. NIH Phase 1 and 2 SBIRs, R01s, and BARDAs are typically always cost reimbursable type awards, and they usually include the ability to rebudget in there. So it's important that you understand that. Now, one of the most important things that you need to understand is you may not rebudget from a direct budget category to an indirect budget category unless you have a negotiated indirect rate agreement. So if you're an NIH grantee and you use their, quote, safe indirect rate of 40% or less, you may not rebudget money from direct labor, direct materials, direct travel, direct subcontractors, or any other direct category to cover your indirect expenses, rent, telephone, utilities, etc. So it's really important that you understand if you don't negotiate an indirect rate, your rate is effectively capped at whatever you wrote in the proposal. So if you wrote 10% indirect rate, that's your indirect rate unless you have a written negotiated indirect rate. So expenses that are not in the original proposal typically comes back to what is it that you're actually doing, what are you actually spending the money on, as to whether it's direct, indirect, or unallowable. And that's always done on a case-by-case basis. So how about a lab jacket? Is a lab jacket a direct expense, an indirect expense, or an unallowable expense? Now, I raised this one because I got this question a couple of years ago. I did a presentation for the Principal Investigators Association, and I got a call about a week after the presentation from a gentleman down in Texas. And he said to me, Ed, is a lab jacket a direct expense or an indirect expense? And I kind of thought to myself before I spoke, geez, usually a lab jacket is something that somebody wears. It makes them look smart, and it kind of protects their clothes from whatever the experiment is they're doing. And they probably wear it all day, so it, quote, benefits all the projects that they're working on, much like rent or telephone or electricity. But rather than give him that answer, I asked why he was asking the question. And he said, well, we do this particular experiment with bovine, and for those of you who don't know, bovine is cattle, and whenever we run this experiment, it destroys our lab jackets. So you can just sort of imagine the kind of research they're doing. And I said, well, that's the very definition of a direct expense. If it weren't for this project, I wouldn't have incurred this expense. So one of the key points that I want you to get out of my lab jacket example is there are absolutely no truly black and white answers unless something is specifically unallowable. It's always determined on a case-by-case basis. So what's a direct expense for one company may be an indirect expense for another. Now, there are traditions and norms, but it's always a case-specific example, and it's always incumbent upon you to determine what's the best indirect rate structure and how you classify things, and you have to make your case to the government that you're effectively being fair. So what the government wants to make sure is that everybody pays their proportional fair share. So it's up to you to determine how you allocate costs. And so you need to set up your accounting system, and you need to allocate costs so that they're proportional and fair, so whoever is, quote, benefiting is paying for that benefit. So employee benefits. Employee benefits are typically an indirect expense. Now, there are 5 typical indirect rate structures. We have clients that have a single indirect rate, so they have indirect expenses divided by direct labor. That's a single tiered indirect rate. We have clients with overhead and G&A rates, so there's 2 pools. We have clients with fringe overhead and G&A rates, so there's 3 pools. And then for our NIH clients, they typically have a fringe benefit in an F&A rate or a fringe benefit in a modified F&A rate. So there's really sort of 5 typical indirect rate structures that we see all the time. And what's been happening lately is, as companies get bigger and there's pressure from the government to keep their costs down, they tend to start having more and more indirect rate pools as necessity bears. So as an example, we have clients with on-site and off-site overhead rates. We have clients with 2 and 3 different levels of fringe benefit rates depending on where the work is being performed and what's the level of worker doing it. So we are very strong advocates for keeping things simple at first and letting it become more complicated as the business dictates. So I get a lot of questions about how do we best recover costs, and honestly it's very difficult for me to give you advice without understanding your facts and circumstances. So most of the time an employee benefit is going to be an indirect expense. Some people will recover it through a fringe benefit rate, some people will recover it through their overhead rate, and sometimes some of those costs will get allocated to a G&A rate. So it really depends on your cost structure, but it's almost always an indirect expense. Now, one of the other points that I really want to make here is the government is going to reimburse you for your reasonable expenses. So I'm going to be speaking at the National SBIR conference down in Austin, Texas on November 29th. And I'll get questions about reasonableness all the time. And one of the things I want to make sure that you're aware of is what's reasonable for a company in Manhattan or Silicon Valley and what's reasonable for a company in Boise, Idaho might be 2 very different things. So as an example, in order to compete for employees in Silicon Valley, you're competing against Google, who sends a shuttle to the employee's location, picks them up, drives them to work, feeds them, takes care of their dry cleaning, and then drives them home. So you're going to have to offer a pretty competitive benefit package in order to attract talent. I don't know that you're going to have to send a shuttle service to pick up your employees if you're in Boise, Idaho. No offense against Boise, Idaho. It's just not the same employment market. So the reasonableness of what's going on in your market is very important to kind of make sure you understand. Now, rent is typically an indirect expense. However, we have several clients who have specialized facilities where only a few of their clients benefit. So they may set that up as a separate cost pool and a separate allocation. But what if you're the landlord? So one of the underlying reasonableness thoughts that you need to have is most of the time transactions take place at an arm's length. So you're negotiating with Verizon as opposed to AT&T or Sprint. So there's competition there, and you really can't control the outcome other than to play one vendor off another. But when you're renting from yourself, especially if you have a specialized facility, you're effectively renting from yourself, and so the allowable rent is subject to a special calculation. So again, rent typically allowable. However, if you are the landlord, you may be subject to special rules. What about accountants and lawyers? This is one of my favorite questions. So the accountants are typically always allowable costs, unless I'm working on your personal tax return, which has no benefit to the business. Lawyers, it really depends what they're doing. So if a lawyer is helping you set up your LLC, or if they're helping you set up a subcontract agreement, or if they're helping you set up an employment handbook, that, quote, benefits the business. But what if the lawyer is helping you raise VC money? Well, the essence of what they're doing is helping you change the ownership of your business, and the government, quote, derives no benefit from a change in ownership. So those legal costs in helping you raise angel or VC monies are unallowable because the government doesn't benefit. What about an H-1B visa cost? So I get this question sort of all the time. I'm, SBIR awardees, and they can't find anybody in their local market who can perform certain specialized tasks, so they wind up hiring a foreign worker and they need to sponsor their H-1B visa. As long as you've taken all the appropriate steps to try to hire an American worker under the SBIR program, it's perfectly legitimate for you to recover your H-1B visa costs because, again, the government is benefiting and you've followed the rules. Patent costs are one of these things that kind of drive me crazy, if you want to be honest. As long as you include the right clauses in your negotiation of your DoD award, patent costs are typically allowable and recoverable through your indirect rates, as long as you're doing business in the country in which you're filing patents. So if you're doing business in the U.S. and you're filing for your U.S. patent costs, those are typically allowable. If you're filing all over Europe and China and you're not doing business there, then those costs would not be allowable because you're not actually doing business in those countries. The NIH sees this as a commercial cost and just will not reimburse you for your patent costs. So again, with the lawyers, it really depends what they're doing. So you have to sort of analyze their bills carefully if you're going to try to get reimbursed by the government or not. And that leads me to a really critical point. When you negotiate with the federal government has the Defense Contract Audit Agency or the Department of Financial Advisory Services negotiating on their behalf. You are responsible to negotiate on your behalf, which is the role we fill for a number of our clients. If you are underbilling the government, they will effectively say thank you, although they'll say it silently. If you overbill the government, they will take great offense to that and expect you to repay them as quickly as humanly possible. So that's a really important underlying thing that you have to understand. We see a lot of new clients come through our doors. They've dramatically underestimated their indirect rates, and they're losing money as a result, and they're wondering why the government doesn't say or do anything. Well, the government's protecting the government's interest. It's up to you to protect your interests. So what we're finding is that indirect rates are a balancing act that most people get wrong. And what I'm going to show you is the way most companies, when they get started with government funding awards, how they think about indirect rates and the kind of mistakes that they make. So most of the time, companies do what I call work backwards. And what does that mean? Well, basically what it means is, let's pretend that I'm an NIH grantee and I'm applying for a phase 2 SBIR, and the total amount of the award that they'll fund is $1.5 million. So the government will give you a 7% fee on these types of awards. So if you divide this number by 1.07 and then multiply it by 7%, you can come up with more or less $100,000 for fee, which gives you total cost that you can be reimbursed for $1.4 million. Now, what most people do at this point is they start plugging in the critical things that they need to convince the government of in order to get funded. So prominent consultant number 1 is going to get $50,000, prominent consultant number 2 is going to get $50,000. We're going to subcontract a large piece of this work to Johns Hopkins or UC Berkeley or whatever. There's going to be $200,000 worth of materials. And then obviously I'm the principal investigator, and there's a couple of other people that are critical to this thing. I'm going to need to reimburse these guys for some level of fringe benefits. And this indirect number up here becomes effectively a plug in order to get to $1.5 million. So what I'd like to do now is make sure that you understand this concept known as the multiplier. And what the multiplier is it's a theoretical number which basically represents for every dollar that you pay in labor and mark up for your indirect expenses, how much do you effectively charge the government? So in this case, this company has an overhead and a G&A rate, and they've come up with an overhead rate of 100% and a G&A rate of 25%. And you can see based on the math that their total multiplier is 2.68. So for every dollar that they pay their employee, so as an example, if they paid their employee $100,000, they're going to charge the government $268,000. Now, to a lot of newbies, That sounds like a lot of money. I will tell you that we have about 140, 150 clients that we take care of on an ongoing basis all over the country. Now, I want you to understand, I'm not asking that you make yourself large, expensive, bloated, or inefficient. But we ask our clients all the time, when we're negotiating with your customers, what kind of feedback do they give you? Typically, an established DoD, SBIR type government contractor gives us the following feedback. When their multiplier is less than 2.4, there's no comment from the government. Typically, from 2.4 to 2.7, the government has normal cost concerns. From 2.7 to 3.0, they start saying things like, boy, you guys are expensive, this better work. And at greater than 3, the government will consider not working with you because they think you're cost prohibitive. Now, the SBIR program is one of the least price-sensitive programs that the government has. I mean, we have clients who do business up at the Wright-Patterson Air Force Base in Dayton, Ohio, and several years ago, the people who run the base basically met with all the contractors and when the sequestration hit and said, hey, listen, guys, if you want to continue doing business with us, you're going to need to find ways to be very, very efficient. And what my clients up there will tell you is they have not seen a contract awarded that was greater than 1% higher than the lowest bidder's price. So depending on the kind of government funding award you're chasing, you have to understand how cost competitive it is or isn't when you're thinking about your indirect rate strategy. So we have a client in White Plains, New York that makes cryogenically cooled microprocessing chips. Their multiplier is greater than 3. The government's attitude is, we don't care, we can't get these things anywhere else. So again, it comes back to sort of your value proposition to your customer, and you can imagine it's fairly expensive to have a foundry with, that produces cryogenically cooled microprocessing chips. So with that said, with NIH, we typically see their cost structures set up a little bit differently. So NIH tends to have a fringe benefit and an F&A rate. And in order to get to that same pre-fee multiplier of 2.5, that's effectively a fringe benefit rate of 35% and an F&A rate of 85%. And a lot of NIH grantees will look at that and go, oh my gosh, that's incredibly high. We have clients who we negotiate F&A rates for that are in the 150 and 160% range. Now, it's not the norm. I mean, these are typically really high-end companies in Kendall Square with incredibly high-end capabilities. Typically, we see fringe benefit ranges between 28 and 42%, sort of depending on where you're at in the country and what you have to do to attract and keep labor. And F&A rates tend to range from 55 to 70%, sort of depending, again, on what kind of cost structures you need to maintain in order to be competitive, given whatever industry it is you're in. So again, I'm not advocating that you come up with a multiplier of 2.5. That's not really your goal. It's really just to sort of educate you and get you thinking about a strategy. So the most important thing that you have to understand is what drives your indirect rates. So in a second, I'm going to show you an Excel spreadsheet that we use all the time. We have an $895 product that we use as an introductory product where we work with new companies and we help them develop the correct indirect rate structure. We help them project the right indirect rate and make sure that they don't shortchange themselves when they prepare their cost proposal. But one of the most important things that you have to understand is there's a difference between having a project and having a business. So when you have a project, you're working in the business. If the project doesn't work and you don't have any technical capabilities, there's no reason to develop the business. However, once your technology starts to become feasible and you start to have a business, you're going to want to start to build strategic alliances, you're going to want to start to diversify your revenue stream, you're going to want to advance your technology, and you need to start making sure that your people charge their time to indirect expenses. One of the key points that we make in our compliance webinar is it's important that your people charge their time properly, and there are a couple of really ugly cases that the government has brought against contractors and grantees that don't follow the rules correctly. And there's a couple of University of Houston professors who are serving jail time right now. So, I mean, this is really important. If somebody's working on a project, they need to charge their time to that project. And if they're working on developing the business, they need to charge their time to indirect labor. Again, it comes back to this, who's benefiting from the work? When you're developing the business, everybody who does business with you is going to benefit. So as a result, that becomes an indirect expense. So let's talk a bit about what happens as a project turns into a business. So hopefully through the modern technology here, I'll be able to make this work. So presuming we work together and you have a fringe and an F&A rate, we're going to send you an Excel spreadsheet. And that Excel spreadsheet is going to have 3 tabs. The first tab is a labor input screen. The second tab is an other cost input screen. And the third tab is the resulting indirect rate calculation. So in this example, we've got Joe's the principal investigator. He's making $100,000. He charges 95% of his time direct to the project, and 5% of his time is running the business, talking to the lawyers and the accountants. He's got Steve Whitney and Dave on the payroll, and they're all 100% direct on the project. In the second tab, you'll notice that the payroll and the payroll taxes come through automatically. And then we've got a section up here for fringe benefits. So you've got workers' comp insurance, health insurance, and we've broken down. We've got 2 columns. One's an annual amount, one's a monthly amount. We've got legal expenses, office supplies, computer supplies. Because we've got 4 direct people, we're going to outsource the accounting and bookkeeping. You'll notice that we have $660,000 plus 9,000 times 12 gives you more than $750,000 in earned revenue on a grant, so you're going to have to hire an outside CPA firm to do your uniform guidance audit, which used to be known as your OMBA 133 audit. Then we've got a section down here for all of your direct expenses, materials, consultants, subcontractors, and this is on all the contracts and grants you're going to work on for the coming fiscal year. So once a year, you're going to sit down and do your best job projecting what your direct and indirect expenses are going to look like for the coming year, and you develop an indirect rate. Now, in this example, the indirect rate comes out to a 14% fringe rate and a 29.9% F&A rate. So let's presume for a minute that the rent of $3,000 a month, that facility was taken, we're going to have to spend $3,500 on this space. The indirect rate goes from 29.9 to 31.2. Not a big difference. What drives your indirect rates typically is how your people, especially your expensive people, charge their time. Now, if you think back to the prior screen, building strategic alliances, diversifying your revenue stream, those things are not going to be done by your low-end technical people. They're going to be done by your high-end expensive people. Writing proposals. Now, if you don't offer your employees fringe benefits, they probably won't work for you for very long. So it's customary to give people a couple of weeks vacation, 10 holidays, 5 sick days. That's 25 days a year. People are going to get paid to not show up for work 8 hours in a day. That's 200 hours a year divided by roughly 2,000 hours a year. So if you offer normal vacation, holiday, and sick time, you're going to have 10% of the time you're going to be paying your employees to not show up to work. So your numbers are going to look more like this. Now, as a result of the fact that your expensive people are charging more time to indirect, your indirect rate just jumped from 31% to 53%. And again, if you're an NIH grantee and you've used a 40% indirect rate and you haven't negotiated your rate, your indirect rate is capped. So you will now lose 13.78% on every single government-funded program you have because you didn't negotiate an indirect rate. The fringe benefit rate leaps because you're now offering vacation, overhead, and sick time. So it's really important to start to understand how your people charge their time is going to have a tremendously big impact on your indirect rates. So again, if your project morphs into a business, it's important that you give yourself a chance to build the business without committing what we call inadvertent fraud, which is hey, we're working on indirect things, but we're going to charge the company, we're going to charge a customer. So you just don't want to establish that kind of mindset. So let's go back now that we've got a little better understanding of what drives our indirect rates and what's kind of normal. Let's go back to this scenario where we backed into our indirect rate. You'll see we've got a fringe rate of 17.6% and an F&A rate of 16.7%. And what's going to happen in reality is you may find it extraordinarily challenging to find competent employees if you're not going to offer them benefits, or you're going to lose money. And it's going to be extraordinarily difficult to do anything but work in the project, or you're going to lose money. VC-backed or angel-backed. And then you're losing money purposefully. You're knowingly going into this, underestimating your indirect rates and purposefully doing it. That's a perfectly legitimate strategy that we see all the time. So indirect rates that are too low create automatic cash flow problems and project cost losses proportional to the degree of the miss. So if you're bootstrapped, what do you think happens? You wind up borrowing money, you wind up not paying yourself, you wind up diluting yourself. So it's really important that you understand kind of what is going on with your indirect rate. So one of the things that I advocate to people all the time is, you know, they'll ask me, hey, Ed, is my accounting system okay or not? And I'll ask them a really quick question. I'll say, how's your indirect rate running right now? And if they can't give me an answer, I kind of look at them and say, well, do you think you have an acceptable accounting system or not? Because if you can't tell me how your indirect rate is running, I can almost assure you that you don't have an acceptable accounting system. So it's probably the easiest litmus test I have for figuring out when people ask me, am I okay or not? I just ask them, how's your indirect rate running? And if you can't tell me, you don't have an acceptable accounting system, and you're probably losing money because your indirect rates are too low. So a lot of times companies will come back and go, oh my gosh, but if we use an indirect rate that's higher, we might not win the award. So if you think about this from the government's perspective, basically in that first scenario where the company is projecting an indirect rate that's too low, they're showing a lot of the costs being spent on direct, and somebody who's projecting a higher indirect rate is spending less money on direct and more money on indirect. But let me ask you this question. If you're running a business and you're a government, so if you're the government and you're hiring a business to handle a problem for you, which one do you think has the biggest chance of going bankrupt? The one that's being properly reimbursed for their indirect expenses, or the one that's not being properly reimbursed for their indirect expenses? So again, we get a lot of fear of people, hey, what if, you know, Stanford's indirect rate is only this, and I like, Stanford is Stanford, MIT is MIT, you're you. The government wants to reimburse you for your reasonable, allowable, allocable expenses, and hopefully you're helping them solve a problem. If you're not helping them solve a problem, they're not going to do business with you regardless of what your cost structure is. So that's really the bottom line on reasonableness and you know, the fear of using a higher indirect rate. So I want to talk for a second about safe indirect rates, and you've heard me mention several times the 40% quote safe rate that NIH allows, and this is a tremendous problem for NIH grantees. So if you have not done business with other federal government entities and don't have a written negotiated indirect rate, when you write a phase 1 SBIR proposal, NIH basically says you cannot use a rate, an indirect rate of more than 40%. When you write your phase 2 proposal, you effectively have to check a box that more or less says, hey, I need a rate higher than 40%, please audit me. Now, I've never met too many people who started a new business and wanted to check a box to have a government agency audit them. But I have to be honest with you. This is probably one of the easiest audits to pass, and we've done white papers on understanding the different types of government audits. So if you go to our website and look in the resources section, there's all sorts of white papers and videos, and we talk about the difficulty of passing different types of government audits. And we'll have another webinar, I'm not sure what the schedule is, but I'm sure it's published up there on the website somewhere. in order to negotiate an indirect rate with NIH that's more than 40%, step one is project the right indirect rate. Step two is put that indirect rate in your cost proposal. And step three is when you get to the JIT phase of the award, you notify the grant specialist that you need to be sent over to the Division of Financial Advisory Services, DFAS, to have a negotiated indirect rate. Now, we do this all the time, so they give our clients somewhat preferential treatment in terms of getting into the queue. But it's imperative, if you're going to stay cash flow positive and you're bootstrapped, that you negotiate that indirect rate. So you have to advocate for yourself. And using a 40% indirect rate and mismanaging your company is not a great strategy. Again, if you're VC-backed or angel-backed and it's purposeful, that's fantastic. It happens all the time. And most of the time when we start talking to companies like that, they really hire us to help make sure that they're compliant and, you know, overseeing their accounting system. So let's talk about safe indirect rates, and I'm going to give you a little scare just to warn you in advance. So I've kind of termed this how to commit inadvertent fraud. So let's pretend that you're an NIH grantee and you've got a phase 2 SBIR award and you don't negotiate a rate that's greater than 40%. So what happens is the Division of Financial Advisory Services never reviews your accounting system, never approves your indirect rate, and the grant specialist performs an extraordinarily cursory accounting system review. So they basically say, can you send me a copy of your chart of accounts? Can you send me a copy of your timesheet? And more or less, that's it. They rubber stamp you. Now, for the DOD contractors out there, you're not going to believe this. So DOD, you do a month's worth of work, you submit a bill, typically using the WAWF billing system, which is a blast in and of itself, and you wait for 15 or 45 days to get paid. With NIH, you win $1.5 million and $750,000 is your year one funding. The $750,000 gets put up into the payment management system, which is like a cloud, and you're given a username and a password, and you can basically go into the payment management system and you log in and you say, I'd like $37,850, and you push the button and the money shows up in your bank account the next day. And from a cash flow perspective, it's a beautiful thing. However, if you're not doing this correctly, and I'm about to show you in a minute how the trap springs, so there's two ways that you spring the trap on yourself. One is if you don't negotiate an indirect rate and you draw down more than 40%, so let's presume that your indirect rate runs at 60% and you're drawing down money to cover your rent and your utilities. Or if you draw down at 40%, now we have clients who work in an incubator and their indirect rate's like 15, 25%. And you're drawing 40, you're still overbilling the government. In both of those cases, you're overbilling the government. So where you get sprung is on a quarterly basis, the government has this obscure-looking SF-425. It's a federal financial reporting form, and you'll notice it's pretty complicated. You know, how much did you draw down? How much did you earn? What did you spend it on? You know, how did your indirect rates? What were what were your provisional rates? What were your actual rates? And right here on line 13, by signing this report, I certify that it is true, complete, and accurate to the best of my knowledge. I'm aware that any false, fictitious, or fraudulent information may subject me to criminal, civil, or administrative penalties. 2 University of Houston professors convicted and sentenced to jail. Again, SBIR program, integrated microsensors, SBIR grants and contracts from NASA, NSF, Department of Energy, and the U.S. Air Force. You can Google it, folks. Very months ago, Washington State University engineering professor has been indicted. You know, he's awaiting trial. This is real stuff. You have to pay attention to this. The government is very concerned with being overbilled and people committing fraud. So in summary, with indirect rates, if you miss too low, you're going to have automatic cash flow problems and project losses. So if you're bootstrapped or lightly capitalized, you're going to restrict the business growth, you're going to dig yourself into a financial hole, go into debt and dilute yourself, or worst case scenario, you commit what I call inadvertent fraud. Most people are very concerned that they're not going to win the award if their indirect rates are too high. We see this very, very rarely. Either your project has merit and it's fundable or it doesn't. So if you do this properly, cost reimbursable type work can be used very successfully to help you build your business and build your ability to solve problems for the government. That's the way the government views this. So how do we work? So typically we supplement your financial team. So we get involved in indirect cost rate development. We will get involved in the financial negotiations with government officials. That's both the DCAA and DFAS, as well as your contracting officer or grant specialist. We'll help you get your accounting system set up. If you've got people internally, we will get them trained and provide periodic oversight depending on how strong or weak those people are. Some companies outsource their entire accounting department to us. We will prepare your annual incurred cost submission. So if you have cost reimbursable work, again, this is a whole nother webinar because it's very involved, but you effectively project what you think your indirect rates and costs are going to be. And when you have cost reimbursable work, you have to prepare what's known as a true-up report within 6 months after your fiscal year end that shows what your actual expenses were. And that report has a 100% chance of being audited. And again, I recommend that you download our white paper on understanding government audits or checking out the recorded webinar. We go into great detail about what happens during those audits. And obviously, our claim to fame is we represent our clients during those government audits. It's important to understand how to deal with the government auditors. It's important to understand why they're asking the question they're asking and how to answer those questions in as few words as possible. You know it's time to call us when you're preparing the cost portion of a proposal and you're not sure what to write in some of those boxes, especially when it comes to indirect rates. If you're not realizing a 7% profit on your grants and contracts, I did an SBIR panel with somebody out in Wisconsin, gosh, 6 or 8 years ago. And he was one of the poster children for how to develop a successful SBIR company out there. And he called me a couple of months ago and said, geez, and this is a company that was doing probably $3 or $4 million a year in SBIR grant revenue and $5 or $6 million in commercial revenue. And he said, geez, it feels like we're losing money on all of our government funding. And we have a risk and compliance analysis. We started digging into his numbers, and it became really apparent to us. We said, hey, how did you guys come up with this 50% F&A rate that you've been writing in all your proposals? Because your actual F&A rate is running at like 65%. So you're overrunning your rates by 15%, your 7% fee is getting burned, and you're losing about 8% on every single grant you work on. And they said, oh my gosh, we haven't revised our indirect rates or thought about our indirect rates in years. So it's important that you understand how your actual rates are running. You know it's time to call Jameson when you're having cash flow problems, you're having unexpected debt or dilution events, you're having problems getting paid by the government. If you don't know what your actual overhead rate is and you ask your accountant and they don't give you an answer fairly quickly, it might be time to give us a buzz. If you're signing that SF-425 and you've got some concerns, or if you're just concerned about your existing financial team, give us a buzz. Sometimes we can help, sometimes we can't, but we try to be straight shooters. We've got an introductory product. So I mentioned this earlier. We've got an $895. We do an indirect rate projection and cost proposal support. So initially, we'll do a phone call screening with you to sort of get to understand your business. We will send you the appropriate indirect rate template. So we'll make a decision based on our conversation what the most appropriate indirect rate structure for you is, whether it's an overhead rate or an overhead and a G&A rate or a fringe overhead and a G&A rate, a fringe and F&A rate, a fringe and a modified F&A rate, or some hybrid thereof. We'll help you project those indirect rates. We'll kick the numbers around a little bit and make sure that, sometimes with different companies, we will run a best case, worst case, and most probable case scenario. But at the end of the day, when you fill out your cost proposal, you'll have some peace of mind that you understand the number that you're using in there to fund your business. So with all that said, we've got time for some questions, and I appreciate we've got about 235 people registered today. I see we've got 136 in attendance, and probably 35 or 40 people sent us questions in advance. So If there's still time, if you want to send me a question in the chat window, I'm going to go until 3 o'clock. But I've got some questions that I went through yesterday, and I threw them into the end of the presentation. So NT asks, are Jamison's fees an allowable indirect cost? They absolutely are. I'm going to be totally self-serving here and tell you that if we work together, when we negotiate your indirect rate, we will make sure that you negotiate enough of an indirect rate to pay us, because our costs are an allowable, recoverable indirect cost. But if you don't project the right indirect rate, it still doesn't matter. You still don't have the money to pay us. And we want to make sure that our clients remain solvent. It's very self-serving, but we'd like you to succeed. Charles N., can equipment rental be included in indirect costs? Charles, I assume that the equipment benefits multiple projects, and therefore the answer to the question is a very simple yes. Happens all the time. Now, how you go about financing that equipment and over what period of time, whether you set up a capital or an operating lease, that's a discussion for a whole other day, but that's absolutely something that benefits the government, and if it benefits multiple projects, it's a recoverable indirect expense. Cindy B. asks, what is the difference between direct and indirect? Employees who only perform indirect labor need to complete a timesheet. Cindy, the answer is incredibly simple. If you want the government to reimburse you for that indirect labor, they need to be filling out timesheets. So if you've got VC-backed system and you only want to be reimbursed for some of your costs, then you don't have to have a company culture where everybody fills out a timesheet. But if you're a bootstrap company and you want to be reimbursed for those people, they have to fill out timesheets. It's very simple. And again, direct labor, if it weren't for this project, I wouldn't have performed this hour's worth of work. Indirect labor is not specific to any one particular deliverable project. So I might be writing a proposal, I might be doing IR&D, vacation, holiday, and sick, I might be at a seminar, I might be building strategic alliances, I might be doing all sorts of different things to try to diversify my revenue scheme. So those are all perfectly normal indirect labor categories. Now, Glenn L. is an NIH grantee, and he says, he asks, what does a company need to do to transition from a 40% indirect rate, and is this more, it seems more complicated, and is it worth the additional accounting requirements? So, Glenn, the first question is, what do you need to do to transition? Step one is you need to project what you think your indirect expenses are going to be. Step two, you need to put that indirect expense into a proposal. And step three, when the government asks you where you came up with that rate, you're going to need to pull out your Excel spreadsheets and your assumptions, and you're going to have to convince the government auditor that what you're asking for is reasonable, or they'll negotiate you down. Now, the question, is it worth the additional accounting required? Well, the question there is, are you VC backed and you don't care if you lose money, or are you bootstrapped and you care if you lose money? So if you're running at 120% overhead rate and you're using the 40% indirect rate and the VCs are subsidizing the rest of it, who cares? Why bother to have the additional accounting requirements? But if you're bootstrapped, then you're absolutely going to want to do the additional accounting. So it's really a question of strategy. Joyce G. is a DoD contractor and says, end of year overhead rate true up. Now she's basically asking, can't bill the government for differences between the provisional rate and the final incurred cost submission until after the submission is audited or approved, which can be 4 to 7 years later. How do I handle this difference? So I'm going to bring you to another slide. So basically what Joyce is asking is, I've got a provisional indirect rate, and let's presume for argument's sake that it's 120%. And I bill the government, so I'm a DoD contractor, I bill the government every month, I get reimbursed for my 120%, and I go and I prepare my incurred cost submission, and at the end of the year, my indirect rate comes out to be 131%. So I'm going to take that 131% and I'm going to allocate it to all my jobs proportionally based on direct labor, because in this scenario, I've got a single overhead rate pool. So this is a mandatory schedule that's going to show up in your incurred cost submission, that true-up report. And you'll notice that all the costs are going to be proportionally allocated to all the jobs that people work on, right? Now what Joyce is asking for is if I bill the government 120% and my actual rate comes out to 131%, how do I deal with that 11.86% where I'm not getting audited for 4 to 7 years? Joyce, when you prepare this report, sign it, and mail it into the government, you now have the right to bill them that 11.86% difference. If and when the auditors audit you 4 to 7 years later and find that it's not 131%, it's 130 or 133%, you then deal with that variance then. But based on all known events and circumstances, you have the right to bill the government because you've now determined my overhead rate is higher than what I've been billing you. So it's your right to bill the government for your actual costs. So. And finally, Marta K., who's another DOD contractor, asks, how do you account for subcontract administration with one overhead rate? So Marta's real dilemma here is that she doesn't have a G&A rate. So the issue there, Marta, is you will not be able to charge the government for subcontract administration unless you have a G&A rate. So you're going to need to probably change the way you account for your indirect expenses. So you may have a single overhead rate and an overhead and G&A rate may be more appropriate. So what you're going to need to do is basically file for a change in accounting method with the government, and you're going to show them this is what we believe to be a more appropriate way to do our accounting. The government will then come in and say, yes, we think that's reasonable, and you will then establish a G&A rate that you can use to bill. Until you do that, you will not be able to recover your subcontract administration costs. So one of the things that became clear to me when I looked at a lot of the questions was, I don't know that people truly understand how the indirect rate works, but it's effectively a cycle. So you do an indirect rate projection, you write that indirect rate into your proposal. Before you get an award, you go through this pre-award process where that provisional or temporary indirect rate gets negotiated. Then at the end of the year, you prepare this incurred cost submission, a true-up report, which basically accounts for the difference between the temporary rate you were given to bill and your actual rate. You're then allowed to bill the difference between the temporary rate and the actual rate when you do the incurred cost submission, which then potentially a year or 4 to 7 years later, depending on the agency you're working with, gets audited. But this goes on an annual basis. This is like a never-ending cycle of something that you need to constantly be aware of. So one of the things that all of our people here are trained on is to try to identify when our clients are having sort of normal cyclical fluctuations in their indirect rates and when structural changes are occurring and when it may be appropriate to step back and potentially think about changing your indirect rates. So it's important that you go through this on an ongoing basis and think about sort of how you approach your indirect rates at least once a year. So I noticed that we're just about out of time, so I wanted to take this time to thank everyone for coming out. Again, we've got some recorded webinars that you can feel free to, if you go to jamiesoncpa.com and go to the resources section, there are white papers, there are recorded webinars. Hopefully this webinar will be up on the website in a couple of days. But I'd like to thank everybody for coming out, and I wish you all the best of luck. Thank you.